Today's topic is what is collection risk, key points in collection risk, early warning signals, how to mitigate collection risk, and the points to remember. The risk that is occurring at the collection of trade receivable stage is collection risk. It is the last stage of the operating cycle when the business collects the receivables from its buyers. Collection risk happens either due to unwillingness of the buyer to pay or due his inability to generate adequate funds to repay the debt. Or it could also be due to trade disputes arising out of quality of goods supplied. Late delivery can also be a reason for collection risk. Or it could be a cash flow constraints at the buyer's end. If the business is unable to collect the money from its buyers, then there is no cash inflow from the operating cycle. To assess the collection risk, we have to primarily look at one, the financial health of the buyer and the buyer's industry, length of time that the buyer and supplier have been dealing with each other, interdependency between the buyer and supplier. Please remember, profit does not repay bank loans. Cash flow does. And that's where collection risk begins. Collection risk in credit appraisal. Key points on collection risk. 1. Weak cash flow management. Irregular receivables, high working capital cycle, poor debtor control, seasonal cash flow mismatches. Even profitable firms can default due to poor liquidity management. Number 2, over dependence on few customers. Top 2-3 customers contributing major revenue. Risk of delayed payments or loss of the key buyer. Concentration increases collection uncertainty. 3. Aggressive credit sales policy. Long credit periods given to customers. Sales growth driven by relaxed credit terms. High sundry debtors turnover period. Next, growth without cash realization. That is what is one of the red flag is all about. 4. Weak promoter commitment. Poor repayment track record. Frequent check returns. Diversion of funds. Collection risk increases when intent is doubtful. 5. Industry level collection issues. Government payment delays. Real estate slowdown. MSME receivable dependency. Export market uncertainty. External factors directly affect recovery timelines. Inadequate monitoring by bank. No stock statement follow-up. Irregular review of receivables aging. No site visits. Poor post-sanction monitoring increases collection risk. 7. High leverage, excessive borrowing, multiple lenders, high debt servicing burden. Cash flow pressure leads to repayment delays. Early warning signals of collection risk. Debtor days increasing. Is the borrower dependent on 2-3 major customers? What is the percentage of sales to top 2 to 3 customers? Is it more than 60% of total sales? Are GST sales matching bank turnover? Is he frequently asking for ad hoc limits? Is working capital always fully utilized? Regular overdrawings, LC devolvement, EMI bouncing. These are some of the early warning signals. How to mitigate the collection risk? Analyze the cash flow statement, not just profit and loss account statement. Study aging of receivables. Check customer concentration. Obtain post-dated checks, escrow wherever possible. Explore the possibility of opening of an LC or providing a BG by buyer's bank. Strengthen monitoring frequency. Conduct regular account reviews. Find out from the audited balance sheet and profit and loss account the percentage of amount of trade debt written off to sales revenue during the last 2 years. If the same is found increasing or is more than 5%, the business is facing collection risk. Find out the amount of provision made for bad debt provided in the profit and loss account. If the same is found increasing or is more than 5%, the business is facing collection risk. Find out the percentage of trade debt exceeding 6 months to total trade debt. If the same is found increasing or is more than 5%, the business is facing collection risk. If the credit facility is provided as a bill finance, verify the number of bills returned unpaid. Find out whether the bills outstanding more than 6 months belong to a particular customer or to all the buyers. If it belongs to one of the customers, it may be due to the buyer's poor financial health. If it is otherwise, the industry to which the buyers belong may be undergoing a period of recession. If the credit facility provided is by way of cash credit hypothecation of book debts, undertake a study to understand the names of buyers whose book debts are more than 6 months old. Remember, smart bankers analyze cash flow. Average bankers analyze profit. A profitable borrower can still default if receivables don't convert into cash. Collection risk is not about capacity alone. It is about liquidity discipline and repayment intent. In credit appraisal, never trust profit blindly. Study cash flow. Study receivables aging because recovery begins at appraisal. Banks don't fail because of bad profit figures. Banks fail because cash never comes back. Profit is accounting. Cash flow is reality. A smart banker studies aging statements. A careless banker studies only the balance sheet. NPAs are not created at default. They are created at appraisal. Thank you all. We have started discussion on the topic of operating cycle video 110 and completed the topic by this video 116. I shall come out with such small videos on lending topics. Subscribe to my YouTube channel, NPI's Learning Modules in Lending, and click the like button, which enables you to get notification whenever a video of mine is uploaded. Follow me on Facebook and on Instagram.